Today, we are absolutely delighted to have an interesting research seminar on IPOs, specifically on whether Chinese IPOs always benefit from private equity investment. This is an interesting area in corporate finance and financial economics. And what is specifically delightful is that we have our very own Professor Hong Bao. And let me have the pleasure of introducing her, although I am aware that she's very well known among so many people and almost each and every person here in this seminar today. But she is a professor in financial economics at the School of Finance and Management here at SOAS University of London. And she's been working in this area for quite a while. Her journey started with initial degrees from Ruanzhou University in China, where she got a BA in economics, then Min University in China, where she got an MSc in economics, and an MSc from London School of Economics around the corner, and a PhD in financial economics from the University of Groningen, where she was working very closely with some of the leading scholars in finance in the world today. So she had absolutely solid training and grounding. Her research is mainly exclusive in financial economics, including issues like farm investment, decisions, and uncertainty, and so many papers in this area, as well as books, capital market imperfections, comparative economic systems around the world, corporate finance, corporate governance, and also a great deal of work on the Chinese economy, which this paper is all about. She's also recently taken a very, very niche, interesting aspect of research, looking at corporate finance issues on the bilateral corporate trade between, say, China and Africa, a component that she is seriously pursuing. She's published in the topmost journals, professional, both, 4-star and 3-star, including the Review of Finance, the Journal of Corporate Finance, a Journal of Banking and Finance, on so on and so forth. Okay. And most importantly, she's also playing a very important role in mentoring researchers around the world. She's a key member of the peer review group of the African Economic Research Consortium in Group C, who mentor researchers across so many universities on the continent. Okay, I could go on talking about her contributions, but we are very proud of her contribution here at SOAS. And this paper is joined with the Dr. Ying Zhu, who is a lecturer in finance and director of the trading floor. That's very, very interesting. It's a interesting answer. The director of the trading floor at Coventry University. I'm not sure whether I pronounced the name correctly. Xu.
Xu.
Xu. Okay. And she works closely, of course, with the Professor Hong Bao. And her research interests include private equity, cross-border M&A, and corporate social responsibility. So her research is perfectly aligned with the research of our Professor Hong Bao. More interesting, she's an important alumni of the School of Finance and Management at SOAS University of London, where she obtained her MSc and PhD. So we are absolutely delighted and fortunate to have both Hong and Boying in this presentation. And at this juncture, I would like very much to welcome you both to start the presentation, which I understand will be a 2-person drama. So there will be a lot of interactions, which is absolutely brilliant. Please go ahead.
So thanks, Victor, for your introduction. And Murinde was my PhD. So, and we know each other for many years. So let me share the file so that yeah. So that is, yeah. So I hope you can see this clearly, right?
Yes.
Yeah. So the arrangement is I'm going to start with the conceptual things, and then Murinde will take over talking about the empirical part. And a little bit background of this paper. So this is basically still based on one of chapters from Murinde's dissertation. So some years ago, we have been struggling with this paper for quite a few rounds. We got some, they gave us some chance from top journals for us to revise, but unfortunately for 2 times we did not manage. So it is still around now. So we are revising this paper. So we realized that because it takes some time for us to get the feedback from journals, and for a few times, that means it is already a few years for us. So we need probably to think about how to update the data, for example, and to improve this one. And as you all know that this is a very, very hard journey. So anyway, so let's talk about this. So I think it's a good opportunity for us to talk about it because we are revising this and we have issues, regarding this paper. So let's see whether colleagues can offer constructive feedback on the paper, so that can help us. Now, it's about China. And I gradually realized that working on China is becoming even harder than, for example, 10 years ago. So more than 10 years ago, I did something on China, and it was relatively easier for journals to accept, something based on the Chinese data. Nowadays, it is much harder, and the competition has been very fierce in this field. So what we are doing here in this one, we examine the IPO underpricing. And IPO underpricing was a very big issue for the Chinese stock market for some years ago, particularly. Now, probably it has been coming down a bit. However, there are some other issues that are, involved in understanding this IPO underpricing. I know that for people who are in this group, probably it's not necessarily that everybody has the background. So I will start with 2 examples to show you what we are talking about. So I have here 2 firms. One is LinkedIn, which is very famous. We all know this, we use this. And the other one is a recent IPO, and that is SenseTime. And that is, I think, is one of the top 5 AI firms in China. And it had a lot of problems in passing through the IPO, particularly when the American government, US government, put this firm on the blacklist, let's say. So, and the firm took another way, so waited, and then the IPO went to public last year, the end of last year already. So what I'm going to say is, when we think about underpricing, it is a very often phenomenon that we observe when firms issue shares on the stock market for the first time. Yeah. So For those two examples, they have, I mean, of course, they have their own issue time, and the offering price is listed here. They have different listed price of course, because the firms are different, and they have different first day closing prices. We are interested in this thing. This is the IPO underpricing. In fact, it is the first day return. So when the firm goes to the public, to the stock market to sell shares to general investors, you will have a kind of a first day return. The first day price is compared with the offering price and divided by the offering price. That is the first day return. We call this IPO underpricing because the return here mostly reflect the how much money that the firm left the money on the table. So they preferred to set up a lower price as compared to the market, and that creates the very high first day return. So very often we observe IPO underpricing is very high. For example, for LinkedIn, it was already 10 years ago. I remember they had that this 100 something underpricing first day return, and that was reported by different media outlets. And this one, it is lower, and I understand why it is lower, because the market has become mature, and particularly this is listed on the Hong Kong market, even for a Chinese firm. However, it is still a positive first day return, although it's not that big. And then what we are examining actually for our IPO, very often we have 200% IPO underpricing. According to the recent research, I think this is the recent research, they report actually the average IPO underpricing was something like 170% in China during this period. And this period is basically the whole period that we have the Chinese stock market, okay, since the start of 1990s and then before the lockdown. So that gives you a kind of impression about the magnitude, the extent to which that we, our Chinese IPOs experienced this IPO, the first day return. And in finance, it is IPO underpricing. So IPO underpricing is a common phenomenon, especially for China, because the Chinese stock market is still not that mature. So that is something. So China has a little bit, not a little bit, it's a higher IPO underpricing throughout the whole Chinese stock, the history of the Chinese stock market. So that is something that we are talking about, and that is something we fit our topic into the literature. Now, the literature, even though this is a very common phenomenon in finance, the literature explains IPO underpricing from different perspectives, aspects. Now, so they say very often the offer price is used by IPO firm as a kind of a strategy. It is you who can decide whether or not you set up an offer price which is higher than the average or lower than the average. Now, so if they set up a lower offering price, That means other things are equal. The market has been already investigated before they issue IPO. So therefore, that will lead us to have this higher first day return because you set this lower than other people. So therefore, that increases IPO underpricing. Now, there are some different factors that can justify firm why they even prefer to set up a lower offering price and leave some money on the table, because this offer price, if they lower that, it is a cost of issuing for them. But why are they still doing that? There is a theory in finance. So traditionally, they use the asymmetric information theory. So if you think you are not that attractive enough, and you still need to attract potential investors, then you should probably use this one to lower it and to attract more people, because then the first day return will be higher. That means the investors will get a little bit higher premium. So that higher premium can be used as a compensation for investors who do not trust you. Yeah. So it's basically a symmetrical information problem here. If you think the market, the investors do not trust you, or you have some issues, then probably you can use this underpricing to attract investors. Otherwise, if you are very confident about the quality of the firm, and you can just set up your offering price even higher, yeah, because you do not need your investors, or the investors in the secondary market, they still buy your shares even though the discount or the premium is less, because they trust you, because they believe that in the longer term they can make money by holding your share. Okay, so that's basically the logic of using this offering price. Now, so there are some different factors. As long as you think that factors can reduce asymmetrical information between investors and the firms, yeah, you can actually set up a little bit higher offering price, and that hurts the first return, but still it can work for you, right? So there are some other factors, for example, the reputation of the firm, the CEO's health condition, etc. However, in this paper, we focused on a factor that is related to PE investment. So we say if an IPO, a new IPO, if that IPO is backed by PE investors, they have received some PE investment before they go to the stock market, we would say their IPO underpricing should be lower. And we see so many research, and they provided the evidence for PE-backed IPO. Indeed, PE-backed IPOs have lower IPO underpricing. Okay, so that's another factor that we introduced. We are talking about one factor that is important to reduce the asymmetric information problem for the IPO firm, and that is whether or not there is a PE involvement in this IPO. Okay, and even going further, so the standard conventional theory, or in the literature conventional explanation about why PE-backed IPOs have lower underpricing is based on PE's contribution to the firm. Okay, so that if you observe a firm is backed by PE investment, you would think that PE investors will contribute to the firm in a longer term. So therefore, if I am a potential investor, I will buy, even though the first day return is lower for me as compared to non-PE backed IPO. The traditional explanation is based on the contribution of PE, the good signals sent by the PE. However, in this paper, we argue that that is not necessarily always the case. So we argue, yes, PE-backed IPO have lower underpricing. That means that they set up the offering prices slightly or maybe higher than non-PE-backed IPO. They do this not necessarily based on the asymmetric information problem, not necessarily based on their consideration of outsider investors. We argue there is another potential channel through which PE-backed IPOs, they have a lower underpricing, and that is they set up the higher offering price because PE investors are short-term investors in the PE firm, in the IPO firm. So we say PE investor, if they are holding, they invested in this firm, but they do not want to stay longer, they can benefit from setting up a higher offering price, and that creates a lower underpricing. But that lower underpricing is not necessarily related to the asymmetric information problem. It's basically the agency problem. And specifically, it is because PE investors are short-term investors in the IPO firm. So that is something we are arguing in this paper. And I have to admit, it is a very difficult argument. So we have traveled a so long journey, and we still have problem with that. Why do we ask this? If we look at our IPO samples, or sample IPOs, we checked the first day return, the first day trading price between PE-backed IPOs and non-PE-backed IPOs, and they are not different. They are not statistically different. And we checked the offering price. We do see that the offering prices for PE-backed IPOs are higher. So we need a kind of explanation for that. And also, we checked the long-term performance of those new IPO firms. And the PE investment, there's no evidence that we can say PE investment has improved the firm's long-term performance. So that is basically something that motivated us to argue we need to think outside of the current conventional explanation of PE underpricing for PE-backed IPOs. So basically, we try to say there is a supply side factor as well in determining how much you left, how high how do you set up the offering price, which will determine the magnitude of the IPO underpricing. So we say, yes, we all observe PE-backed IPO have lower underpricing. Traditionally, they say they gave investors a less discount because they think PE investment sent out a good signal. We say it is the agency problem that also plays a role here. So we try to explain from the supply side rather than from the demand side or from the investors' perception of the firm. So that is something that we are doing in this paper. And we think the angle that we explain this is new. We do not see that many existing papers that particularly explain lower IPO underpricing for PE-backed IPOs. So they all explain this from the asymmetric information problem, and not directly from the supply side, from the PE, short-termism. Yeah, and we also, I think there are some IPO firms underpricing papers, but they focused on the IPO market. We now combining the PE market and the IPO market. And as a person who knows Chinese market a little bit more, I would say those are all very speculative markets. Yeah. So we combine them and put them together and to explain. So let me go down to the theoretical part. So we have some theories here, and those are not new. Those are very conventional for people who understand a little bit IPO and the pricing. They have to touch upon those existing theories. So value-added activities of PE investors. So that's why you need a good PE investor. If that PE investor is already well established, has a very good reputation, and they have a lot of networks, so they can bring in those resources to the firm that they invested. So those things are the so-called value-added activities. Also, if you introduce PE investors to your firm, then there is a monitoring role of those PE investors. Normally, they are holding quite a bunch of shares of this firm, even though before their IPOs. So they have a voice in decision making, in monitoring the founder, CEO, for example. So there is a monitoring role that is connected to the PE investors in a firm. And those are well accepted. And of course, there is certification or signaling role of PE investors. Even though we do not consider value added or monitoring something, only considering the fact that as a small firm, I am chosen by a very reputable PE investors, that itself will send out a signal to the stock market. So people who are thinking about buying buying the firm's shares, my firm's share, they will say, okay, that's a good thing because you are endorsed by a very good PE investor. So there is a theory which says there is a certification role of PE investors. Now, those are very good theories, and they explained why PE investors are so important, but they are based on the assumption that those PE investors are good investors. Good, by that I mean they invest in the firm and they think about the long-term performance of the firm. They think about they will grow together with the firm, and then their return will rely on the profit, the growth of the firm. If that is the case, then we would say PE investors they should involve in the corporate governance of this IPO firm. Imagine if they involve in your performance, long-term corporate governance, then that means your long-term performance should be improved by PE investment. Okay, so there is something there that if you trust those theories, then you can logically derive this is something that we should observe. As I said, we do not observe this in the Chinese market. Yeah, we very often we observe that yes, PE investors they jumped in and they exit very quickly after the IPO. So there is so that's basically the fundamental theory. But since we do not observe that, so we now looking for an alternative explanation rather than the conventional, asymmetric information category. So we propose that we see that there is a short-termism in IPO firms for PE investors. And we investigated a little bit in the existing theory literatures. I mean, not too many, but they do have something that says that it is possible for PE investors that they only keep their target on IPO. They will benefit from the IPO process and then they exit. So it is a short-term orientated investment. So we have something about VC investors. So VC investors are different from PE investors because VCs are very often related to the very early stage investment. And whereas PE investors are very often invested in the real activities already, and they take the firm to the IPO. Yeah, and sometimes they grow with the IPO firm, but they do not very often do so, at least not in China. And there is a literature, reference that says that higher offering prices are actually very necessary for PE investors to evaluate their initial investment in the in the IPO firm. So basically, they prefer to see the higher offering price IPO price, so that increase their initial investment value, and that means they have guaranteed or they have protected their value of investment in the IPO firm. And we do see some papers that talked about the power of PE investors. So we were challenged by some referees saying that, okay, in China, whether or not they have a voice in deciding the offering price. And we do think they have the power. And in general, they have the power because very often the firms that they invested in is actually a very small firm. So they can do that. It's up to them whether they are really they are doing this. So there is another theory that is related to our argument, and that is the market timing IPOs. So what this theory says that actually, if you look at the pattern of IPO, very often we observe IPOs are clustered with it together. So sometimes we observe this is a cycle of IPO period, so the so-called IPO hot market. The reason that they do so is that they can get a better price. Yeah, everybody for a firm as an issuer, I want to sell my shares at a higher price. So therefore I target a good time. I should target a hot market, IPO hot market. So therefore, that's why you see when we have an IPO during this period, we have a lot of IPOs, and then afterwards we do not see that many IPOs. Yeah, because everybody can take advantage of everybody else. If it is a hot market, at least my offering price is higher, and at least investors, outside investors, can think about this, can treat this higher offering price as a signal of a good fundamental of those firms. In fact, this is not true. This is sometimes mistaken by the investor. So, but there is a market timing. In our empirical research, we consider the market timing in addition to our PE variables. We argue that actually, yes, we agree there is a market timing, but market timing can be motivated by either the firm wants to increase the firm value, and that should be good for the shareholder. So that should be good for the long-term performance. However, it can also be motivated by the PE investors' short-term horizon in the IPO firm. Think about it. If I'm a PE investor, I catch up this IPO hot market. We set up a little bit higher offering price, and then after the IPO, very often there is a restriction on the period after which, as a PE investor, I can sell my shares. Very often is 1 year. So if I have had this hot market, IPO price was higher, that means the following years I still have a relatively higher price. So I benefit from not only the evaluation of my original investment, but also when I sell that after the lockup period, I can benefit from relatively higher prices. Yeah. So that's our argument. So that is something we are thinking about. If the firm is doing this for firm value consideration, then we should observe better long-term performance. Otherwise, we should argue this is something related to the PE invested short-term horizon. And here I present you with some stylized facts in terms of the Chinese IPOs. Why we think in the Chinese IPO market and the PE market, a lot of speculative behavior, so that we argue PE investors are short-term orientated. We observe that the recipients of PE investment are very often privately owned firms, small, young firms, and in the high-tech sector. So they do not have the financing from Chinese formal financial channels. So it is them who definitely desperately need PE investors. And there are some studies based on the Chinese PE. They say PE, they also document that PE firms in China are not institutional investors, so they are very short-term. Yeah. Also, IPO firms often use those kind of PE investors as a package. So just to package your firm in order to pass through the IPO regulated approval process. And this is particularly the case for China, because China for a long time, the IPO firms has to reach, for example, 3 years profitable numbers before you can apply for the IPO. And that is something we had a book chapter on this. Actually, that book chapter is quite I think is very informative. So we did find a lot of evidence on that. So firms are using IPO not necessarily for the long-term thing, but just for this IPO approval process. And yes, so as you can imagine, Chinese market has been mainly supply driven, i.e. investors are ready sitting there waiting for new IPOs. When there are some new IPOs coming to the secondary market, they jumped into the market. Whatever they buy, they do not care about the risk because there is no supply. Yeah, so that is basically the situation for China. Particularly for this type of things, we argue that created a lot of speculative motivation when you think about both the PE market and the IPO market. And we do have some evidence in this paper, Journal of Banking Finance paper. We provide consistent evidence that convince people that Chinese equity offering, indeed, market timing is a very, very important motivation. Yes, we talked about seasoned equity, but the same, yeah, because, again, supply driving. And so therefore now, based on those the background of, I do not know what I have been talking about, the theories and et cetera, we set up the following hypothesis. And this is my last one. And there is, first of all, there is a negative relationship between PE investment and the IPO and the pricing. And this is true for all PE-backed IPOs. We see that there are two, possibilities. If PE investors are long-termism or long-term, orientated in the IPO firms, then the traditional explanation, i.e., value-added activities, monitoring role, and certification effect would dominate other effects. Therefore, PE investment should improve IPO long-term performance. Otherwise, if PE investors are short-term orientated, then it is unlikely that we observe PE investment can improve IPO long-term performance. So that is something that we have before we go to the empirical part. I think maybe I used too much, but just to, it's difficult to explain clearly. But Pe, so you can take over now.
Thank you for introducing the idea of our paper. Now it's my part. I will start with the data part, the empirical model, and explain our results. Okay, so our sample contains 1,301 IPO cases that were listed on the Chinese stock market. Our sample period runs from 2001 to 2011. We choose this sample period because it mainly covered the booming IPO market in China. And we also stop at 2011 because there is IPO suspension starting in 2012. In our sample, it contains 296 PE-backed IPOs. So PE-backed IPO is defined as if the IPO is backed by either a registered PE investor or a previously PE investor, but has now been switched to a pre-IPO PE investor. So our PE sample contains two types of PE investor. In terms of the data resources, all the PE-related information is collected from Asian Venture Capital Journal. And for the rest of IPO-related information or firm information, we collect the information from the SISMA database. Yeah, so in terms of empirical model, according to our hypothesis, we look at both long-term and short-term performance of these PE-backed IPOs. For the short-term performance, we use the Hackman two-step selection model, because we think the decision of receiving PE investment is driven by the selection bias between the IPO firm and the PE investor, and it's more likely that firms with better quality and performance will be chosen by PE investor. So Hackman two-step selection model can help to correct the endogeneity problem with our data. So for the Hackman two-step selection model, we have two stages. In the first stage, we have a probit model. So P dummy variable is used as the dependent variable. And for the independent variables, we control for firm-related information. We also control for region, industry, and years. After the first stage, we calculated lambda to be added to the second stage of the model. So in the second stage model, we look at how PE affects IPO underpricing. So underpricing is used as our dependent variable. We have two measurements for underpricing information. We have the initial first-day return, and we also have the market-adjusted abnormal return. That's for the dependent variable. For the independent variables, we control for firm-related information. We also control for IPO-related information. We also have lambda as the independent variable. We also control for region, industry, and years. That's for the underpricing model. We also check the long-term performance because we want to find out whether PE does affect the portfolio's long-term performance. So for long-term performance, we use the buy and hold abnormal return as the dependent variable. And for the independent variables, we have P dummy, and we control for other firm or IPO-related information. That's for the whole sample test. We are also interested in PE-backed sample. So we want to find out whether the PE-related information can actually affect the underpricing for the PE-backed IPO. So we rerun the model. We rerun our model 2 and model 3, and we replace PE dummy by PE-related variables. There were 3 of them. The first one is the PE size in the IPO, which is measured by the lateral logarithm of PE investment into the IPO firm. This information tells us the real input of PE investor into the IPO firm. The second measurement is the board membership of PE investors, which is a dummy variable. The value equals to 1 if PE investor sits on the board, and 0 otherwise. This variable helps us to understand whether PE is involved into corporate governance or monitoring or have any monitoring role into the portfolio company. Lastly, we have PE reputation. The PE reputation represents whether this PE firm comes from the top 30 PE investor in China. Again, if PE has a high reputation, it may have an impact during the IPO, during the initial IPO process. Okay, so that's for our model. If we can have a look at the graph on the following page, the graph give us an overall impression of how the IPO developed during our sample period from 2001 to 2011. And so you can see during our sample period, there's a booming IPO market, especially after 2005. So in 2004, there is a new stock market established in China called the SME board, which aims to help with small and medium-sized companies to be listed on the stock market. And again, in 2009, another stock market was established in China called the Chinese board. The Chinese board aims to help high-tech and startup companies to be listed. And during the same period, we can see the PE-backed IPO numbers, which is the blue line, also increased dramatically. Especially in 2009, the number of IPOs issued in this year almost take up 50% of the total IPOs in the year, showing that PE has largely engaged into the IPO issuing in China during our sample period. So this is the first graph. In the second graph, we show the y-axis shows the total amount of IPO proceeds. Again, we observe the same huge growth over our sample period for both IPO firms and PE-backed IPO. So this confirms that IPO has largely, PE investor has largely involved into the IPO process in our sample period. And now we move on to the descriptive statistics. So in this table, we didn't report all the results. We tried to report the information related to the dependent variables, some of the key independent variables, and any information that is significant, has a significant result. So if we look at the initial return between PE-backed and the non-PE-backed IPO, we can see PE-backed IPO tend to have lower underpricing on the first day. But if we look at the long-term performance, BHAR 12 and the BHAR 24, we don't see any significant difference between the two samples. If we look at the other independent variables, we can see PE-backed IPO tend to be slightly older in terms of age, and they have slightly lower leverage ratio, although the result is insignificant. PE IPOs also tend to be backed with more reputable underwriter and have larger IPO proceeds. Lower delay. The delay is measured by the offering day and the IPO day. PE-backed sample also tend to have less control for the funder, which is measured by the top one variable. And also PE-backed sample has less state ownership. For other variables, we can see that PE-backed sample has higher price updates. They're more likely to issue an SEO 2 years after their first listing. PE-backed IPO also tend to are more likely to be listed on the new board compared to the main board. And they also, most of them tend to be issued after 2005, which is measured by the book buildings variable. So from here, we can see there is some different behavior or between the PE-backed sample and non-PE-backed sample. Now we move on to our real empirical part. So the first question is that whether PE has an impact on the underpricing and how does it affect the underpricing? Yeah, so that's our Hackman two-step selection model. In the first step, we can see PE dummy is the dependent variable. And we can see that firms with larger size and lower leverage ratio are more likely to be selected by PE investor. And based on this information, we calculate the lambda, which will be added as an independent variable into our second stage. So if we look at the second stage of this model, we have two dependent variables, the initial return and the market adjusted initial return. We can see from the empirical results, PE negatively affects our underpricing in both models, and the result is negatively significant. Number result is also significant, which shows that that our Hackman model use is valid. We also control for other variables. So that's the result for the whole sample for the initial underpricing, which confirms that PE does result lower underpricing compared to non-PE-backed IPO. So this is our very first result. We're also interested in how PE-backed IPO performs. So maybe some PE-related factor can help to explain the underpricing. So for this model, for this result, again, we're using IR and MAR as our dependent variable, and we have three PE-related variables. These three PE-related variables are added one by one into our model. In the last model, we add all of them into the model to see the joint effect. So from the results, only PE funds tend to be negatively significant in all our models. PE board and the PE reputation doesn't seem to have any impact on IPO underpricing. The results suggest that only the real input of PE investment into the company is related to the underpricing. So now we move on to the long-term performance. So we want to find out if PE results lower underpricing, what is their role in the long term? So for the long-term performance, we divided the sample into whole sample and the PE-backed sample. For the whole sample, the dependent variables are BHAR and BHAR 12 and BHAR 24. In both models, PE dummy doesn't seem to be significant. Then we move on to the PE-backed IPOs only. In the results, the PE fund variable is negatively significant in the 12-month period, but not significant in the 24-month period. The other PE-related variable, PE board, and the PE reputation are not significant in any of our results. So from here we wonder why so from this result, we can see that PE doesn't have any significant role in the long term. So we wonder what is the reason for our IPO, lower PE-backed IPO underpricing. Then we move on to our robustness test. So the first robustness test is on whether in PE affect the fundamental of the IPO firm. So instead of using stock market measurements, now we use sales and the return on equity as the dependent variable. You can see from the results, for the whole sample result, PE does not have any impact for both measurements. And if we look at the PE-backed sample, again, we didn't find any significant results on the firm's fundamentals. Yeah. Next page, please.
Sorry, Murinde. So how do you measure fundamental variables in this robustness test?
So we use sales and the return on equity to measure the firm's fundamentals.
Oh, sorry. Yeah, you indicated that.
Yeah. This is another robustness check, which is another very interesting one. Because previously we found that PE-backed IPO experienced lower underpricing, and we confirm for the long-term performance that PE doesn't play any long-term role. Then the question remains, then what is the reason for lower underpricing for PE-backed firms? So in this table, we compare the PE-backed IPO with non-PE-backed IPO, and we measure the difference between closing prices and the offering prices. So for the closing prices, you can see that PE-backed IPO has slightly larger closing price compared to non-PE-backed IPO, but the t-test result is insignificant. If we look at the offering prices, PE-backed IPO receives a much higher offering prices on average compared to non-PE-backed IPO, and the t-test confirmed that the difference is significant. So based on the results, we can say our first hypothesis is supported. So PE-backed IPO in China experienced lower underpricing, which is consistent with the standard literature. Regarding our second hypothesis, we didn't find, if you can go back. We didn't find evidence on PE dummy or PE related variable has a positive impact on IPO long-term performance, which supports our second hypothesis, saying that they don't actually involve in any long-term activity in the portfolio firm. And also from a robustness check, the result confirms that the lower underpricing of PE-backed IPO are likely to result from the overpriced IPOs, meaning that these IPO firms set up their high offering prices. So that's the result from our empirical test. For the conclusion part, if we look at the mature markets, PE investors are institutional investors. They're very experienced. They seek long-term investment. They involve into the company's management. They involve in corporate governance, and they benefit through the long-term growth of the target firms. However, if you look at China, where there is weak investor protection, there's no information transparent. The PE investors here are relatively short-term profit-driven. They don't really interested in only long-term profit. They don't involve in any corporate governance into their portfolio firms. All they want to do is to make the investment, and they want to exit as soon as possible after the lockup period. In order to achieve that, they set up their high offering prices, especially during the hot IPO period. The high offering prices can signal their good fundamental to the market, which is not really the case. But the high offering prices can help to guarantee a high return for this PE-backed IPO, especially for the PE investor who wants to exit the firm shortly after the listing. So that is the main result from our paper.
Yeah.
Yeah.
So you finished?
Yeah.
Okay, so we finished, Victor. So now it's over to you, and let's see whether we can have some questions.
Okay, so let me give a hand of applause. I hope joining me in giving a hand of applause to Boyne and Hong on a very interesting paper and interesting presentation. It was very, very clearly presented. The issues are extremely important for understanding IPOs in general, and also specifically Chinese IPO, and try to add a lot of contribution to the literature, especially distinguishing IPO from private equity investment. A great paper, great contributions, clear motivation, innovative model and methodologies for the testing, especially taking into account the decision that are captured using the Hackman two-stage procedure, and interesting findings. Now, I have some comments, but I will not abuse my position as chair of the meeting to start with the comments. I think I've posted some comments in the chat, but let me go around and get comments. Please use the button that shows the hand like that, like the one I've now clicked on, if you want to ask any question, and then we can call upon you to make your contributions. So the first hand is from Tolu. And mine is just a proxy. I can always extend it to the bottom. So please click and put up your hand when you want, for comments on this great paper. But the first comment comes in from our very own Tolu. Tolu, you have the floor.
Yeah, thank you, Victor, and thank you to the presenters. I'm sorry I joined you late, but I think I joined you at a very interesting point when you were presenting the results of your study. I found the presentation interesting, just to support Victor as well. But I have two issues which I think will greatly improve the results. One has to do with the impact of the microeconomic environment on the performance of IPO. Your study covered 2001 to 2011. A little bit of a surprise that you did not control for the impact of the financial crisis. We also know that IPO, there is what we call IPO wave. And the second presenter alluded to that when she made use of hot IPO period. So there's a need for you to control for the impact of microeconomic factors on the performance of IPOs. My second issue relates to the measure of corporate governance. I think you use new board as a measure of corporate governance. I'm not sure how that covers the quality of corporate governance. I'm sure what you wanted to cover is the quality of corporate governance on the performance of IPOs. So the use of new board may not actually capture the construct that you wanted to capture. I'm sure we have people, researchers have made use of board size or the independence of the board. Perhaps you may want to look at those two variables on the results. Again, thank you for the presentation. I found it very, very interesting.
Thank you, Atolu, for those important observations you've made. Much welcome. Maybe I can ask Hong and Boyin to respond. Some of them, there was a question, but some of them were comments. But maybe any quick response from Hong and Boyin?
Yes. Boyin, can you respond? Do you think you can respond, right? Yeah, you can.
Yeah, thank you. Thank you for the comment. I think for the financial crisis, we used to have a model including the financial crisis as a dummy variable. Yeah, as you said, IPO comes in waves, and the financial crisis has an impact on to all IPO markets. But I remember in that model, when we have the financial crisis dummy variable, it doesn't have any significant impact in China, if I have remembered correctly. But I can double check that information. I remember that is one of the comments we received from one of the reviewers, so we added to our model, but because it's not significant, so we remove it out of our model. But I will definitely check on that. Thank you for reminding us. Eric, another thing is related to the corporate governance. Apart from new board, we also control for the founders' ownership and also control for the state ownership. I think that also help us understand how the corporate governance is run in these companies. We didn't control for board size and the board independence. Yeah, but we can try to add this variable into the model to see if they have any significant impact.
Yeah, but before they are listed, where do we have the information about the independent directors, et cetera, So we do not have that many elements that are related to the corporate governance, I would say. And thanks to Lu for the 2 points. And I think Boyin didn't mention hot market. So we have a variable that controls for IPO hot market. So we can, I think that one is the ratio of number of IPOs in this year divided by total number of IPOs during the whole period. And I remember that was one requirement from one of the referee report. So we do have that variable, so that to control the hot market. So for the corporate governance, Tulu mentioned new board. Actually, this is not something related to firm level corporate governance. So what is that is China had originally had 2 main stock markets, and that is Shanghai and Shenzhen. But then later, they established 2 other stock markets. One is in Shenzhen, but both of them are in Shenzhen, but one is called the Growth Board. Growth Board means that this is the stock market board that they attract a small, medium-sized firm to be listed. Because otherwise, for the main board, they are not able to meet the requirement. So they were not able to apply even for being listed on the main market. So there's a main growth board, and there's another board, and which is called the high-tech board. And that is board that was purposely designed for firms, particularly small and medium-sized firms that's in the high sector. So therefore, we distinguished between main board and new boards. So this new dummy variable, this new board dummy takes care of where the firms is listed. So it's not necessarily related to the firm level corporate governance. So that is institutional something that I should say. Yes, but macro levels, we do need to consider probably more macro variables rather than financial crisis only, because we do not think, financial crisis had a significant impact on the Chinese financial system. So, but the idea is still there. There are some other macro variables that we should consider. So I think that is my response to Pulu's question.
Yeah, thank you. Thank you both Boying and Hong for shedding further light and responding and acknowledging Tolu's contributions and comments. Yes, indeed. I think in the writing up of the paper, I guess that there is a footnote to acknowledge the fact that you did try the global financial crisis. The footnote would then respond to defray the possible attack from any recalcitrant referee who once shoot down the paper on the basis of say, why was the global financial crisis not acknowledged? So there would be a footnote to say this was taken into account, this mention, but it is not accepted by the data on which we are placed, so it does not have an impact. Otherwise, if it's entered, it should have a degree of significance. And then also, I think maybe the interpretation of the quality of corporate governance. Is it the quality of corporate governance? Is it the independence? I think that's also maybe at the heart of Tolu's comments. And how do we measure the quality of corporate governance if it's the quality? So these are some of the observations. Yes, my good friend Abi Kadir, good to see you.
Okay.
Please go ahead and make your comments.
Okay, thank you. Can you hear me, Victor?
Yes, I can hear you very well.
Okay, very good. Thank you for the presentation. And my comment is just only one point on the methodologies that you have used, two-step Hackman estimator. This is just to highlight that there is a critique of this estimator being suffering from a generated regressor model problem, because you are generating the lambda in the first stage and plugging it into the second stage of the modeling. So that is one, the generated regressor model, or the generated regressor problem is highlighted as a critique. So be aware of that one. The second one is maybe to say a little bit more on the exclusion restrictions that you have used, what you have included in the first stage, which didn't feature on the second stage. Or in addition to that, maybe do you use a limited information maximum likelihood option or the full information maximum likelihood option? Because Monte Carlo experiments have shown that the full information maximum likelihood leads to a better and reliable result relative to the limited information maximum likelihood. And this is already embedded in the generic Stata routine. So I just want to highlight these points to you because, as Victor said, some referees might shoot at these empirical problems, and the generated regressor problem was really around there for almost 20-25 years. Okay, thank you very much. Otherwise, very clear, nice paper.
Thank you very much, Abby. Absolutely constructive comments and suggestions. Yeah, because this is what happens with the development of research each day. Standard methodologies are under attack and observation. You remember way back when GMM has been introduced, and we all were using it, very well. And Manuel Llano was, he on this. And then, of course, you get the attack from Rudman on the purification of our instruments. And so I think, thank you for mentioning those new inferences. I don't know whether Hong or Boeing wants to respond, but I think your comments were very clear and helpful in terms of saying, okay, this is what has been used, but we can't very much sanctify those methods. We need to acknowledge the critiques that have been leveled against some of these methods in the very recent literature.
Yeah, we accept that. Actually, I do not know this detail, and Brian probably knows, but I would say we would go back and checking whether or not we used the full information and maximum likelihood as the option. So we will check that.
Thank you very much. Thank you very much. And
we thought, yeah, sorry, Victor. So in terms of the exclusion restrictions, we did not do that explicitly, but I have to admit we should have done that. And this is because after Brian, that paper, I have been involved in some other papers in which we use the Hackman approach. So I realized that, yes, so there are more. So we need to consider in the first stage model, we need to consider what are the exclusive variables. And that is important. I'm aware of this literature, and I can provide Brian with more references in this. Thank you. Thanks for the comments.
Thank you very much. Just to come in while I await for a further comment, Abby, your hand is still up. Is that a legacy hand? Okay, yes, you have put it down. Okay, thank you. Okay. Okay. Oh, yes. So we've got another comment from Najim Edene Serau. Please go ahead and present your comments on the paper.
Hi. First and foremost, thank you so much for your presentation. And also one thing I've been thinking about is with the rise of big funds such as SoftBank and Tiger Capital, which are doing a lot of Series E investments that are very big and also put themselves in a lockup period post-IPO of a year, etc. I'm wondering if this kind of model reflects the same one as private equity ones. Obviously, they don't take as much controlling shares, but with the rise, especially nowadays, of VC funding, I wonder if the same models can be applied or if a different one should be applied to these.
Thank you. Yeah, very good observation. Hong, Boeing?
Brian, do you have anything? I would say, yeah, I think the model can be applied. And of course, if we consider other macro level, or even industry level variables, we should have different variables. However, I think the model basically is applicable.
Yeah, thank you for that. Yeah. Actually, the inclusion, if not macro levels, industry level, may help at least, to acknowledge that this was taken into account. Yeah. Do you have anything to add, Boeing, or that's
so
fine?
I think the reason why we established model is that we want to have provide like additional explanation to the current theory, and we do hope our model have a wider implication, not just at firm level, but has a general implication at a macro level. So hopefully this works in different scenarios as well.
Yeah, thank you. And yes, it's straightforward. You can, acknowledge that, those elements which maybe have not been taken into account can be done so in further research, but also that there are, important aspects that could be addressed if this framework was extended. So pointing us, the remaining researchers, to look into it, or which will be your next paper, of course, extending this from there. Yes, Dak, you are welcome, Dak, to as usual, good to see you. And we remember very much Dak's inaugural professorial lecture a couple of weeks ago. So welcome indeed. Please go ahead and share your thoughts with us.
Thank you very much, Victor, and thank you very much for the presenters. And I thought it was a really excellent presentation. I learned a lot. It's not my particular area, but I kept wondering a bit sort of around the importance of underpricing, or whether that was a problem or not. And so maybe there is something you can highlight as well, is are there any structural problems if there is a large underpricing, or is this just a distributional issue? And if so, what is the problem that actually you're solving? You're trying to solve. So, do you want to have less underpricing in the future? And if so, then what would be the policy implications of that? Sort of if private equity have a role or doesn't have a role, what is then in the next step that we need to take from that? Why is this so important? Because I thought the paper was really interesting about the short-term and the long-term effects and having difference. And then the question is, what do we want to do with it? And the other question I had is sort of, I mean, you discussed China. Is there something specific about China, and do you have any insight into how this might compare to other countries, and is there something specific there? So, I mean, these are quite very general questions, which may go beyond the paper, but I'm just taking this as an opportunity to ask these general questions. I found it really interesting. Thank you.
Yeah, thank you very much, Dak, and you have an extraordinary insight into some of these issues. And your question is interesting because the research itself and the findings from the research, to think about them a little bit further and to see whether they would, send important signals to practitioners, the regulators of the IPO market, and of course to public policy. So I think that's particularly important. Maybe if we think a little bit more about them, maybe we can then communicate the question, in a different way. So that's also helpful. Hong, Boeing.
And thanks, Dirk. So it's very stimulating, and particularly the first one. And that made me immediately think of what I'm doing here. So why do I do this? And that is really, really important and insightful. And I need to think more about that. But at the moment, I would say, first of all, this topic has attracted a lot of academic attention in finance because higher underpricing means that the firms have left a lot of money on the table. That is the cost of issuing. Because think about, they should have get more money by setting up a higher offering price, but then they deliberately set up a lower price so that they suffer from this higher underpricing, but then they have some other objectives in doing so. So I think on the firm level, the topic is interesting because the firms are concerned about how much money that they should leave on the table when they go through the IPO process. So that is something on the firm level. On the market level, on the stock market level, let's say regulations, in terms of regulations, I think they do not want to see that much, that's higher underpricing, and that may create a lot of speculations on the market, for example. And so I think that is something we can think further in terms of the market regulation, and of course, and that is related to the macroeconomic situation or the policies, including monetary policies. So that's one thing. But I need to think more about that. So the second one is about China. So what are the special things about China? And for that one, I'm more confident in telling you that the Chinese market is different in terms of the, market, the investors' behavior, or even firms' behavior, IPO firms' behavior. Even they, not only PE investors, are speculating by using this IPO as a mechanism to exit their investment. Not only PE investors, but also IPO firms themselves, because they are short-term as well. They are speculating because they want to, they are facing a lot of regulations in China, which that's something that can differ between the Chinese market and other mature market system. In mature market system, if you think you are almost there, you can, just like us, you register, you apply, and then they will check something and then they approve you. But in China, it's not necessarily the case. They have the quota system for a long time. And so they set up a quota, not everybody who is even qualified that can apply for this. So therefore, as I said, that there are some speculative elements, and not really some, quite a lot, speculative elements in the Chinese market. And that's why we say, if you combine the speculative PE market and the speculative IPO market, and it is even more speculative, I would say. So that's something. And from that perspective, we can also link this to the regulation. Yeah. So that's my response. But very important to remind me to think about why we are doing this. Thank you.
Thank you indeed, Hong and Boeing, for the response to those helpful comments from Dak. Okay, let me go back and see whether there is any hand up. Meanwhile, we await any further observations and comment. Let me just share my reflections, which already reflected in the chart. I think the first observation is about to what extent the paper is trying to explore the heterogeneity of investors in Chinese IPO, the question being that it's assumed in the context of the literature, corporate finance literature, about the heterogeneity of investors, and in terms of the fact that the investors don't have homogeneous risk preferences. Some investors are risk lovers and they always, buy. The risk goes up. Some are risk averse, and that may explain some of the differences. So it may well be that this the heterogeneity of investors is captured into some aspects of the paper, and forgive me if I haven't spotted that in the discussion, or if it is somehow reflected in some variable definitions of the paper. The second comment, which also derives from finance theory, is about the heterogeneity of firms, because the Chinese IPO, going into which specific firms. And I think there is an attempt to look at those firms, and is whether that a classification of those firms takes into account the peculiarities of some of the firms, globally, where you find that some of the firms are producing or associated with reversible investment, in which case, really investors don't worry so much about, investing in that IPO because the company has, the company is producing goods that have second-hand value, so they can't lose totally. But if the firm is associated with non-reversible investment, then there is always a problem that the investors may not get any scrap value or from that investment. So the question here is whether there is recognition and attempt to distinguish between firms with reversible investment and non-reversible investment, something that, of course, Hongbo has done in other papers, but specifically try to see whether this is recognized, or it may be that the conjecture is that it will not change the conclusions at all. Now, I do not claim to know the third point is I do not claim to know as much on the Chinese market as Hong, Boeing, especially both of them combined. So my point here, my third point may be outlandish. It is the point of trying to think about how these IPOs are issued. If they are issued and they, especially when you have a signaling effect there, if they are issued and there is you have certification and signaling effect. So I assume that these IPOs are issued, they are certified, and in certification it may well be that there has to be a levy paid, or a tax paid, or a stamp duty. Stamp duty is very associated with some of these, for example, IPOs in the UK. But in China, is whether it's a tract. The bottom line is that trying to see whether the issuance of IPOs in the Chinese market attracts some version of a transaction cost. A transaction cost, additional costs simply from the value of the IPO. Okay, there will be a value which is paid as a result of a transaction, and this may affect, the demand as well as the supply. This may affect, for example, why some IPOs may not go up. This may affect, for example, may able to explain the divergence between the offering price, okay, and then the price after the transaction, okay. So in the formula that you have, where you have the first day trading price and then the offering price, you could even put that in natural log if you wanted. The argument here that the existence of transaction costs, mainly transaction costs that arise from the activity of the regulators or active governments, where they impose, say, a tax levy or a stamp duty, this may be explain the divergence between the offer price and the first day's trading price. And if so, then of course it would be important to integrate transaction cost in this argument if it has not been. And as I say, I think that you have better knowledge of the market than myself. The fourth point, again, I could have to admit here about your knowledge that some of the work we used to do, maybe a couple of years back, in some of my work with some Chinese co-authors, we're always trying to distinguish between shares A and shares B in terms of the companies. Is this an issue, or it's already incorporated into the alignment, in which case I apologize. Okay, those are my limited observations. As I said, if they might be useful or dismissed, or just may result into a footnote, if that helps. Okay. So.
Yeah. So, Boyin, do you want to start, and then I add whatever you have? Let's see how much you can do. Or you want me? You can say I start first.
If you can start first, and I will add on. Thank you.
Yeah. So, Victor, you are tough, right? So you
No.
quite a few issues, but I think they are very relevant. I think we can always do something based on those comments. So the first one is about investors' heterogeneity. So I have to say we didn't consider this in our model. I said that, so we believe, particularly for the period that we covered, it was really hot actually. So it's all about supply driving. We didn't consider the investors and how they how they are different and how they affect this IPO underpricing. We assume that the market, once they got to the secondary market, everybody is ready there and to buy. So, so that's something. And in addition to that, we do not have the information on particular investors. And those are not institutional investors. They are individual small investors on the secondary market. So that's something. However, we can maybe go to the IPO perspectives, looking at other buyers. So in the primary market, we may be able to get some information about, bigger investors, larger investors. So yes, we do not have some that very established institutional investors, but there are some institutions that are involved. So that's something, but we cannot do that for the investors on the secondary market, but we can consider something in the primary market. So before they go to the secondary market. So that's something. And for your second comment, and that was about, I would interpret this as a kind of features of the firm's real activity, particularly in terms of their investment or, let's say, their industries. So what they are doing, you asked us to consider whether or not this firm is in a kind of business in which that their investments, they have no options to regret their investment decision. So reversible or irreversible. So I think this is something that in the industry, in our empirical analysis, we include the industry dummies, and that is somewhere we can put. However, we can we can check further by splitting the sample based on, for example, a specific proxy for their real activity, for their investment. Yeah, we can do that in terms of the subsample. And but I'm wondering how. So I take this as a control variable rather than a k variable, because I do not really. It is not that easy for me to see why this irreversibility something is connected to the PE firm's horizon or short-term horizon in the IPO firm. Maybe they are related, but let me think about that. So that's the second one. The third one is about the transaction cost. To be honest, I have read quite a few IPO papers, PE papers in China. I do not really know that they explicitly talked about the transaction cost, apart from political something. Yeah, there is a transaction cost in terms of your political connection. Yeah, if you are connected to some political regulators or state, even the government, local government, probably you will have an easier process for your IPO, especially when China implemented the quota system. So the quota system, they select So whether or not they select you is not really based on the merit of the firm. It can be something else. So I know a paper which was published in Journal of Financial Economics, I think before the lockdown, they talked about the political connection in IPO, in Chinese IPO market. So that is something that I can think of. In terms of the monetary cost, I'm not aware of something like that. I think they have to pay commission. They have to pay fees, definitely, to pass this process. But I do not know. There's no empirical study that can give me the evidence that how much they pay and whether or not this is significant for their issuing. And the last point is about the distinction between A share and B shares. And I think this is relevant because B shares are mainly for people, investors who buy by using foreign currencies, but A shares is mainly the domestic one. And I know B shares was abolished. I think I forgot that year, maybe the beginning of 2000 something. They abolished that one. So now there is no distinction between that. However, that may be relevant for our sample period. We need to look at that and to control, maybe to add a dummy variable to control it. So that's something from me. I do not know whether I missed something, Beryin. If you can maybe, how much do you think you can add?
You've already nailed it, Hong. I love your explanations and your insight. I think if in reverse order, if shares A and B were abolished, then possibly now doesn't matter. Expect for some of the periods in which in your sample, if the distinction were there, and of course that's something that could be acknowledged. If, for example, they were available for only 20% of the sample period, then maybe it's not worthwhile to do the investigation. And so that could only be acknowledged that the sample period is outside the currency of the practice of A and B shares. On the transaction costs, I think that I've done these on markets. I've done this study transaction costs on markets which had policies. They don't announce these policies, okay? They don't announce why they are doing it, but they had an underlying reason, okay, especially in the UK, that they would create a intervention in the market with stop-go cycles. So throw sand in the wheels or reduce just simply by changing the transaction for the stamp duty. And a clever way of you don't actually just state that you are trying to slow down the market or you are trying to pump up demand, okay, but just by doing the variations. So however it may well be the case that the stamp duty or certification duties in China are constant. If they are constant for a 10-year period, or if they are constant throughout the period, through your sample period, then of course there is no point, because then they are constant. There's nothing much you can do. You just add a value in the econometrics as the covariate if it has got a cross time variations. If there are no variation, then it won't capture any impact. So again, my knowledge is limited on that. If it is constant, then there is no need. If they have been changing quite frequently, even without making a statement as to why these are changing, then there is a value of doing kind of that investigation. And you quite on the other point of reversible, non-reversible investment, that's actually easier to do. If you have the names of the company in which there was IPOs, you can do that at a single sitting. in less than an hour, and then you have a covariate in the model. Okay, do you have anything to add, Boying, or it's up to you?
Yeah, I think for the cost of IPO, I think for all IPO issues is related to stamp duty and other costs. I think and I haven't seen any, as Professor Bo has said, I haven't seen any study on that. The only thing that's related will be the political cost, which is related to quota system. But the quota system has been stopped in 1999. So I don't think it is tightly related to our study here. And in terms of A share and the B share, I think we can have a look at during our sample period. Yeah, we can definitely check during our sample period to control for the B share. But right now we just focus on the A share market.
Thank you very much. It seems there are no further comments, observations. But again, the paper, the presentation, and the recording will be available on the Center for Global Finance website. And if you, for all people both here and who have not been able to make it to this meeting, to have a look and provide comments that they can send directly to Boeing and Hong to be able to value and enhancement to the paper. So let me take this opportunity to thank you most fundamentally, Boeing and Hong, for this very interesting paper, for giving us the opportunity of this dissemination of sharing into your work and to comment on it. And let me thank all the participants for their observations, comments, and time, importantly, to be able to join with us in this seminar. So we shall be appearing here again on this same Teams channel next week with a paper from Arun on fintech transactions. Thank you very much, and have a nice evening, a nice day for those people who are in the States and they have just started the day. Have a nice day ahead of you. For those in the UK or other countries, for those I think in East Africa especially, it will be late in the evening. So have a nice evening. Thank you indeed. Thank you.